Hello and welcome to the fourth video for Chapter 4 in Accounting 205. In this video I'm going to be concentrating on pages 416 through 422. The discussion is individual retirement accounts, otherwise known as IRAs. Okay, there are primarily two types of individual retirement accounts. One of them is called the regular or the traditional IRA. All right. With a traditional IRA, you make a contribution to your IRA account, which, by the way, can be done up to the filing date of that year's tax return. So that means that you can make a contribution to an IRA up until April 17th, 2018 and make it retroactive to 2017. Okay, if you make a contribution to a traditional IRA, it is deductible this year, and if you go to Form 1040 and we look at page 1, all right, in the adjustments to adjusted gross income area, all right, which is lines 23 through line 35, you will see that the IRA deduction is on line 32. Now again, you only get this deduction if it is a traditional IRA. All right. The other type of IRA is called a Roth IRA. With a Roth IRA, there is no effect on this year's tax return because there is no deduction. All right. Basically, what you do is you are taking an amount and you are and it could be coming out of your paycheck, but either way, it's still going to be post-tax dollars. And you set up an IRA with your local financial institution or your broker, and all the contributions again are made with post-tax dollars. And so, but the good part about the Roth IRA is that once you've met the 5-year holding limitation rule, you can withdraw that money tax-free, all right, including the earnings tax-free, as long as you don't withdraw it before the age of 59.5 years old. Okay, so on page 419, it mentions about what are the limitations on IRA contributions, and they have been this way for quite a number of years now. Basically, the limitation for either a traditional or a Roth IRA is $5,500 a year for the taxpayer and or the spouse. If your spouse does not work, you can still make a contribution up to $5,500 for him or her. All right, okay. If you are 50 years of age or older, there is an additional $1,000 catch-up contribution, which means you can contribute up to $6,500 of contributions in a given year. All right, there are two phase-out tables that you have to be aware of, okay? Now, if you're using tax software, the tax software will automatically take care of this for you. But if you're doing like a quiz or a test, you need to observe these tables. Okay, for a Roth IRA, if you look at the bottom of page 419, if you are single or head of household and your AGI is over 118,000, okay, the deduction starts becoming limited. All right. And it tells you basically, how this occurs. If you're married filing a joint return, then the phase out of the contribution starts at $186,000. All right. On the top of page 420, all right, it gets a little bit more detailed because those are the phase out ranges for traditional IRA contributions. Okay, so first of all, how do you know that that these may apply to you? Well, if you look at page 420 and look at the table, All right, it happens to mention that you are either a plan or not a plan participant. What this means is whether or not you are a participant in your retirement plan at work. Now, if you look at Form W-2, okay, there is a section on the Form W-2 where there's a little box and it says retirement plan. Okay, there are actually 3 boxes side by side, and the middle one is for the retirement plan. If that box is checked, that means that the taxpayer is an active participant in their retirement plan. Now, that doesn't mean that they actually contributed to their retirement plan. That means they are eligible to contribute to their retirement plan. So it's critical that when you are entering the information on Form W-2, that you check that, you make sure you look at that box to see if there is an X in that box. Because if there is an X in that box, then the taxpayer is limited, okay, as far as how much they can contribute. Okay, if there is no X in that box, then there is no limitation and you don't have anything to worry about. Okay. Okay, so if they are for example, let's say your taxpayer is single and they have a retirement plan at work. Okay, so you would look at the second line down in the table on page 420, and it says there that their phase out, meaning that if their AGI exceeds $62,000, okay, that means that their IRA contribution is going to be phased out. Now, how exactly do you compute that if they are subject to the phase out? Okay, what you do is you look at the bottom of page 420 and the top of page 421, okay, and it will show you some examples, all right, on what those phase outs look like. Also, there, as you know, there are problems at the back of each chapter, and I've given you the answers to those problems. Okay, and so try to work the problems and then peek at the answers to see, if you were able to do these right. Now, there will be questions on your test involving IRAs, so you should practice this, okay? Whether or not you're going to do it on paper or you're going to practice using the software, that's up to you, but you should practice this because this is very important. All right, getting this wrong could have a major effect on your client's return. Okay. All right, the next thing, all right, that I'm going to talk about. All right, we're going to talk a little bit about conversions and distributions, and I will cover that in my next video.